what we're going to be going over here is cost volume profit analysis, where we're going to be looking at the sales ratio scaling factor here for bundled products. This is where we're going to be looking at the sales ratio here for multiple products that are going to be grouped together. And for our example, it's going to be based on the bundled products here of products A and B. So we only have two products we're going to bundle together here. And we're looking at the income that these products are generating. Okay, so what we're going to be looking at here is we're going to be looking at a budgeted amount here on these products, and we're going to have to determine a sales ratio for that versus the actual amount that we sold for these products as a bundle group here, and we have to determine the sales ratio on that. Okay, so starting with our budgeted amounts here. So what we have budgeted here, and for product A, we're going to sell a quantity of 30,000 here for product A, and for product B, we're going to sell a quantity of 10,000. So our sales ratio here is just 3 to 1, and that's simply taking your B amount here of 10,000 divided into the A quantity here of 30,000. So you're going to have 3 units of A here, a quantity of 3 here for A for each unit of B that you're selling, or for each B that you're selling. Okay, so and then for B, you just got 1 unit here, 10,000 divided into itself for 1 unit. So in a bundle here, there's going to be a quantity of 4 here, 3 of A, 1 of B. Okay, so we know here, well, what is our total sales? 30,000 plus 10,000, it's going to be 40,000. A quantity of 40,000 split between A and B, and it's going to be for both the budgeted amount here and our actual amount. So that's how we came up with our 4,000 here, our 10,000 bundles. Simply a quantity of 4 here between A and B divided into 40,000, total quantity of 40,000 gives us 10,000 bundles here. Okay, now for our actual sales here. So this is the case here where our actual sales have changed here. A, we've sold 36,000 of A and 4,000 of B here. So that's going to give us a 9 to 1 sales ratio, simply taking the 4,000 here of B divided into 36,000 A. That gives you 9 here. So for each unit of B here that you sell, you're going to be selling a quantity of 9 of A. So that's where you get your 9 to 1 sales ratio, just going through that. In total number of our quantity in a per bundle here is going to be 10. We're going to have 9 A's, 9 of product A and 1 of product B, so a total of 10 here in a bundle. Now for our bundles, that's the case here. Again, you got 40,000 here, and total quantity of that sold divided by 10, a quantity of 10 per bundle. That's going to equate to 4,000 bundles. So you can see budgeted, we're going to be working off 10,000 bundles here based on our budget, but on our actual sales, based on that sales ratio here, for the actual sales, we have 4,000 bundles. So this is where we're going to have to do some conversion here. We don't have to do the conversion. The numbers all come out the same here when you do your analysis, but I'm doing it here just to put them on even keel here, what we're going to be looking at. So for our actual sales here, that was that 9 to 1 ratio that we calculated. I want to convert that over to this. Instead of looking at it in terms of a quantity of 10 here, I want to actually convert this 9 to 1 sales ratio over to a quantity of 4. So how I would do that here, so I can make the comparison here, looking at our budgeted amount here. When we do our comparison, I want to look at the budgeted versus our actual amount based on 10,000 bundles is what I'm trying to do here. So to do that conversion here, let's just look at it. 36,000 here, the actual sales, divided by total sales here, 40,000. For product A, product A represents 90% of our sales. And then we want quantity of 4 here per bundle here. I want to convert from 10 per bundle here to 4 per bundle. So I take 4 times the 90% here, so that's going to give me 3.6 here. So for product A, I'm going to be selling 3.6 to every, in this case we'll look at 0.4, quantity of 0.4 here for B. So B, we just take, again, what we have sold here, 4,000, divided by the total sales of 40,000, represents 10%. Again, 4 per bundle, so 4 times 10% gives us 0.4. So that's our new sales ratio here. Now it's exactly the same, equivalent to the 9 to 1 ratio. It's just that I converted it over to 3.6 to 4.40, so I can match our budgeted amount here based on 10,000 bundles. So what we had here, originally we had 4,000 bundles here based on a 9-to-1 ratio here, but after the conversion, the 3.6 to 4.0, we did the arithmetic here, and now we've got 10,000 bundles that we're going to look at based on our equivalent sales ratio here, 3.6 to 4.0. Now we can look at our budgeted versus our actual sales based on those 10,000 bundles. Okay, so again, just looking at it here, that 9-to-1 ratio here equals 3.6 to 4 here, and this is where we're going to be able to compare those 10,000 bundles with the actual, or the budgeted of 3 to 1 here. We'll be able to compare that to the 3.6 to 4.0. Okay, based on that conversion. So the key is here, and we'll go look at it on our cost volume profit graph here, but we're going to be able to look at both our budgeted and our actual sales here based on 10,000 bundles that we sold here at that 3.6 to 0.40 ratio. And that's equivalent to the 9-to-1 ratio here, but the 9-to-1 ratio, we'd be looking at 4,000 bundles. So I would just want to just look at that. We're going to have a scaling factor here. Okay, so let's go over and let's look at our cost volume profit graph here. Then this is the case here. I got the bundles sold here in thousands showing across here on our x-axis. Along our y-axis is our dollar amounts here in 1,000. And what I'm showing here for our sales ratio here of 9-to-1, I'm showing a revenues line here, and that's the on a per unit basis here. So actually what I'm showing here is $21 here on a per unit basis here. For every unit or every bundle we sell here, $21 here is going to be generated as revenue here based on that 9-to-1 ratio here. And then on our costing line here, it's going to be $14.40 here. So for each bundle we sell, we're going to have a cost of $14.40 on it. And the difference between $21 and $14.40 gives us a contribution margin here of $6.60. Okay, so this is where we have our 9-to-1 ratio showing on our green line here for our costing line and our brownish line here for our revenue lines. And again, remember here, our costing line includes that $12,000 fixed cost. So our costing line is our variable cost here. The $12,000 here on our y-axis in dollars is our fixed cost here. Okay, so the only difference here between our 9-to-1 ratio here and our sales ratio here, 3-to-1 here, is really these lines that we're looking at, the steepness of lines. On our what we're going to really be looking at is the 3.6 to 0.40 ratio here. And I'm showing that really in those dashed lines here. So what we're going to be able to do is really compare our budgeted amount here to our actual sales based on a quantity of 10,000 here. So let's go and let's see what that factoring or what the scaling is between our sales ratio here, showing it at a 9-to-1 ratio here for our revenues and our costing versus our costing for revenues and costing here based on, well, 3-to-1, or really 3.6 to 0.40. Okay, so this is what we're talking about. For our bundle sold here, we're going to have 4,000 here based on that 9-to-1 ratio here, and then 10-to-1 ratio, or 10,000 bundles here for both our 3.1 and the 3.6 to 4.0 ratio. So this is the scaling factor we'd have here. So just look, this is where we're looking at this sales ratio scalar amount here. So in our bundle sold, let's just look at it. The 9-to-1 here, what we're going to do is we're going to be comparing that to 3.6 to 4.0 because 0.40 because they are equivalent. And our scalar is based on looking at either the 9 to the 3.6 here or 1 to 0.4. So let's look at the 9 to 3.6 here. So taking 9, divided it here by 3.6, looking at that factor here, that's going to give us a scalar here of 2.5. And how we can use that here is looking at it in these terms. So say, for example, we have our 10,000 bundles here. The 10,000 bundles that we're looking at, we can divide that here by that scalar of 2.5, and that's going to be equal to 4,000 bundles here. So that's the relation that we're setting up here. The 4,000 here bundles here is based on that 9-to-1 sales ratio. the 10,000 here is based on our 3.6 to 4.0 plus the 3 to 1 ratio here. Okay, so let's go and let's just apply that here. Okay, we went through, say for example, we can, knowing our numbers here, our revenues, costs, and our contribution margins, knowing one, we can determine the other. So let's just look at the case that we went through here. So we predetermined that our revenues here was $21 per unit, $14.40 for cost, difference contribution margin of $6.60. So going over here to our, and we'll look at it in terms of the 3.6 to 4.0 numbers here. Using that scaling factor, we'll just take for our contribution margin here, we'll just take the 660 up here and divide it by our scaling factor of 2.5 that we have. That's going to give us $2.64 as a contribution margin here per bundle or unit of sales here based on that 3.6 to 4.0 scaling factor. That's equivalent to the 9 to 1 ratio. And then for our revenues here, for that ratio here, we'll just take the $21 here that we have for the 9 to 1 ratio here, divide it by 2.5 here. Scaling factor gives us $8.40 here for our revenues line on a per bundle basis. And then for our costing line, it would be just the $14 here divided by 2.5 for $5.76 here per bundle for our costing. Now, had we known the values over here, for example, then we could have determined what our 9 to 1 ratio was simply by, in this case, we'd have to multiply whatever, for example, here we'd have to multiply our revenues here on a per bundle basis times 2.5 to determine what's up here. So knowing one, you can determine the other. So here's the case here. We've taken that scaling factor of 2.5 here, and we've converted our 9 to 1 ratio here for our sales, our revenues, and our cost here. We converted it over to the 3.6 to 4.0, 0.40, excuse me. So we can determine here, look at our comparison here based on 10,000, a bundle here of 10,000 for both our budgeted amount here and our actual amount. Okay, so let's just look at it here. So for example, and predetermined here for our budgeted amount, if we did the arithmetic, we would have had what? We would have had $3 here in a contribution margin per unit basis. We would have had $9 here for per unit revenue cost and our revenues here generated, and $6 per unit here for our costing. The difference would have given us $3 here for contribution margin. So what our earnings would be here, what we've earned here, we just take $3 of contribution times that 10,000 here, units, our bundles that we sold, that gives us 30,000. Subtract out our fixed costs of 12,000, so we have 18,000 here. A revenue here based on our sales ratio of 3 to 1 that we budgeted here. Now we can look at our actual sales here and using the $2.64 here that we calculated based on that factoring ratio here for the 3.6 to 4.0 ratio here. So we're really comparing our budgeted amount here on a 3 to 1 ratio versus our actual here at 3.6 to 4.4. Okay, so looking at taking the $2.64 contribution margin times 10,000 here gives us 26,400. Subtract out our fixed cost here, 12,000, gives us 14,400. Okay, so that we can easily compare here with, by looking at it here, looking on our graph here, we can compare that to what we budgeted here of 18,000. So we're actually under, or we've got generated less income here based on the contribution margins that we have. We went down here because it just happened to be that we were selling less of our more expensive item here, and more of less of an item here that was generating more revenue, and well, anyway, we'd had that mix here where our revenue of our more expensive items that we had here, we were generating less income on that, and we were selling more of the less expensive items. So we were generating less revenue and that's why our costing went down, our earnings went down here. Now, we could have just looked at it in the case here of the 4,000 bundles here, just looking at it. We have that $6.60 contribution margin times 4,000 bundles. Again, gives us 26,400, same as we had here with the 10,000 units. Subtract out our fixed cost of 12,000, we get down to 14,400. Same numbers here. It's just the fact is, using the graph here, it's a little easier to look at it when you've made the conversion here from the 9-to-1 sales ratio here, looking at those revenues and costing lines. It's easier to look at it here and make the comparison here when you're looking at the 3-to-1 versus the 3.6 to 4.0. That's the only thing we're making, we want to understand here. And the other point is, for both units here selling at the 4,000 bundles here and 10,000 bundles, we have the same quantity sold, and we'll look at that. So for our quantity sold here, for A we have 36,000 and B 4,000, total of 40,000 quantity here. It's just a matter of what was included in each of those bundles here. With our 10,000 bundles, we had that quantity of 4 here for A and B, and with our 4,000 bundles, we had that quantity of 10, 9 for A and 1 for B. But in either case here, we still have 40,000, quantity of 40,000 for each. Okay, so that's our scaling factor here. Now let's go down and let's just prove out these numbers here going through our income equation here. And this is simply, let's look at it. It's really, I've got the income equation laid out here. It's selling price minus variable cost times our quantity, and we do that for both our product A and product B here. Subtract out our fixed cost, and that's going to equal our operating income. So not going through all the numbers here, what we want to do here, we want to plug in for our sales ratio here of 9-to-1. We want to look at our product A here, 9Q here. Product B is going to be 1Q. That is that total. So we have a total of quantity of 10 here for our sales ratio of 9-to-1. Plugging it in here, variable cost minus our fixed cost. You can go through the arithmetic if you want. But what we're going to come down to is that contribution margin here on the 9-to-1 is $6.60. Solving for Q, so we're going to have $6.60 as total contribution here. Margin, that's selling price, variable cost, times the quantity for each of these A's and B's here, adding them together. And then we move our 12,000 over to the fixed cost over the other side of the equation and add it to our operating income here. I'm just using this here as we had 14,400 above, so I've just plugged that in here for operating income. So now after we've solving for Q here, that $6.60 is a contribution margin per bundle here, divided into 26,400, and Q would equals 4,000. And that's divided up here where you're going to have 1 Q or B here. Product B is going to have a quantity of 1, so per bundle here they're going to have 4,000 here. So quantity for B is 4,000, and for A we'd have 9 of those. Each bundle has 9 in here, so 9 times 4,000 is 36,000. So that's total of 40,000 here. Just went through this income equation here to prove those numbers that we looked up above. Okay, so now moving down to our 3.6 to 4.0 ratio here, our 0.40 ratio, which is equivalent to the 9.1. So all we did is put in for a product A a 3.6 Qs here, product B 0.4 Qs, and went through same numbers here that we had up above. Sales price, variable cost, and so forth, less our fixed cost, equals our operating income's the same here. And solving for Q, well, we'd have our total contribution margin going to be $2.64. That's what we used up above here, and that's really that factoring that we had here. 660 divided by 2.5 got us down to 264, and then that again equals moving our fixed cost over here. We're going to solve for our quantity here, and our quantity is going to be 10,000. We had up above here, we had our bundles, our quantity is 10,000. Up above we had 4,000 here, and that's where we'll be using this conversion ratio here, converting that 9-to-1 into 3.6 to 0.4440. We come up with 10,000 bundles, and then looking at it in this case here, since B is going to get 4/10 of a Q, that's going to equal 4,000 here for B. It's quantity of 4,000 for B. A gets 3.6 of 10,000 here, or times 10,000, and that equals 36,000. So you can see here, just going through our operating income equation, for that income that we are generating here, same number here, just to prove those numbers out that we looked up above. For product B, we have a quantity of 4,000 in both cases here, using both our different sales ratios here. And for Q, or for product A, 36,000. Comparable down here, using both ratios, just to prove out that these ratios here generate the same numbers. It's just that we wanted to look at those bundles here for looking at our sales versus our budgeted versus our actual. We want to look on them based on that 10,000 quantity. But you can use either one. It really doesn't matter if you're using your ratio 9:1 here, or what we converted over 3.6 to 4.0. You're going to get the same numbers here. It's just that looking at the 3.6 to 4.0, it was probably a little easier to look at it when you're trying to explain this on a cost volume profit graph, and you're trying to explain it to somebody or rationalize what's going on here. Because when you looked at the 9:1, you had those larger revenues and cost lines here compared to what we had, but what we really were looking at, what you had budgeted, the 3.1 or 3:1 ratio. So converting the 9:1 to the 3.6 to 4.0, we could probably more, and the numbers all fall out the same, and has nothing to do with the quantities and the incomes and that. You can use either of these sales ratios, has no factor in your numbers if you're doing it, just looking at equations here. But if you're looking at it on the graph here, it didn't make a difference. Okay, so that'll summarize our discussion here on that sales ratio scaling and how we'd use it here when you're looking at trying to compare budgeted versus actual sales. When you have actual sale of dollars here, when you're looking at sales ratios here that are really far apart, when you want to make a comparison versus the sales ratios, they are the same here. But if you look at them on the graph, then you have probably a little better understanding when you make the conversion.